time for Top That Trade. Joining us now for our trader game, Phil Flynn, a Fox Business Network News contributor, and Alan Nuckman, the chief market strategist at BullseyeOption.com. Round number one, guys. Forgotten stocks, downtrodden, Tesla and Apple are trading at almost the same price right now, right around $180 per share. What do you think is the better buy for a behemoth bounce?
I'm all about the charts, and the charts look almost exactly the same. A slow grind down. Nobody believed. They made a bottom base, and they bounced. Now we need to see some follow-through, but I love the risk-reward. Apple is up 6% versus the S&P up 25% over the last 1 year, whereas you've got Tesla, a lot more upside. It's down 40% since last July's highs, and it's essentially unchanged on the year. So I like these big boys. I think the sentiment has shifted, and that's super important as a trader.
If you had to pick one at this level, I like them both. I pick Tesla. Tesla does have a lot more upside, as Alan pointed out, but also in terms of market share, right? Apple lost the electric car race to Tesla. Tesla is the Cadillac of electric cars, excuse the pun. And because of their technology, I think they're going to continue to dominate the electric car space. Yes, they have a lot of challenges, but Elon Musk, I think, is better positioned than any electric car maker in the globe to stand up to the Chinese, stand up to the competitors. And I think they have the technology to go beyond electric cars that I think gives that stock more value over the long run.
Round number two, wheat squeeze. Wheat has bullishly broken out from its bottom base. Why is that bad news for traders who are hoping for grain pain?
Well, it's bad news for the consumers because it could add to more inflation. Interestingly enough, in just a few hours, we had a report from Russia who are warning about a damaging frost that could create shortages of wheat. If you look around the globe, there are challenges in the global grain market, unlike anything we've seen in a lot of years. And it's funny because the market's been taking it pretty much in stride. The commodity funds have been selling. There's not a lot of risk premium in these prices. But I think reality is going to start settling in here in the next few weeks. And that could mean a major bottom on wheat and the rest of the grains as well.
We've seen a bottom of wheat. We've been between 5 and 6. If you look at WEAT, the ETF that tracks wheat, anybody can trade that. It's been between 5 and 6, breakout of the 6, target 7 on the upside. So there's a lot of potential there, as well as corn. The CORN ETF has been in a range between 19 and 23. So we made some bottom bases in these, and what we could see is with the heavy fund shorts, if they have to reverse their positions, that can move the market. You're only going to see about 5 cents of wheat actually in a loaf of bread. So it shouldn't have an economic impact on your bread and your toast.
Round number three, China cha-ching. Chinese stocks have surged as projected right here. Now that the stock market is up in the U.S. and China stocks have rallied back 30% in just 3 months, how would you cash in?
Wow, it's just been momentum everywhere. It's not just us, as I often say. So, you've just got to be careful. You've got to find sectors and subgroups that maybe haven't participated in the rally. Things can get very hot very fast, and we're making an approach on the all-time highs of the S&P once again.
Geopolitics, of course, and bad economics has really hurt China. I think the China leadership right now is starting to realize they made some major mistakes from an economic viewpoint, and they've got problems. But from a stock viewpoint, when you realize you have problems, that's the first step to solving some of them. If you look at one of the stocks that I like, if you like the stocks the way it is, you look at JT, that's kind of like the Amazon of China. That stock's been really beaten up. It's around $32, $33 a share. We think there's a high probability that this stock could double by the end of this year. So keep an eye on that, save the tape.
For your bonus round question, a stay-at-home mom's salary. Should it be $50,000, $120,000, or $185,000 for their hard work?
I got to go with 185,000. Just look at daycare alone. I think
who
that's
would be silly enough to say
$180,000.
a lower number on Mother's Day? That's silly. 185 plus 1.
Wise, very wise. It's $185,000, although we know it's priceless. And moms who work and care for the family, that's priceless too. Great job. Business First Dan will be right back with a mom trader after this break.